Let's get a quick check on the Philippine markets. The Philippine Stock Exchange opens this Wednesday higher by about a tenth of a percent at 6,343. The stock market closed yesterday, Tuesday, lower by nearly 2%. As for the Philippine peso, it opens today at 55.58 to the dollar. Peso closed yesterday slightly weaker, 55.63 against the greenback. And for this briefing, our guest says the biggest risks currently looming over Philippine markets are a U.S. recession driven by tariff shocks, a potential negative reversal of trade talks, and U.S. protectionist policies. With us now for more is Kyle Garcia, equity research analyst of First Metro Securities. Good to have you, Kyle. Thank you so much for joining us.
Of course. Thank you for having First Metro Securities.
It's quite a mouthful, isn't it? And it's quite toxic when you come to think of the confluence of all three. What are the chances that the confluence of all three is more likely? Or is it less likely from the time this year started? We got Trump going with the tariffs.
Got it. So far in the past, as the start of the year, we weren't really pricing any of these things. But when Liberation Day came, it seems like more and more of these things are starting to confide into each other. But so far right now, the U.S. markets is pricing at about a 38% U.S. recession. So still unlikely, but so far, hopefully it doesn't happen.
Do you agree with that? 38% or a little bit higher?
I'm not sure about the numbers, but I think it's well in line. We're really afraid of that. So for our end case target, for our bear case target of about 5,800, it's really that U.S. recession that we're pricing in terms of that higher equity risk premiums.
True, but I'm looking at the bond market and seeing whether there's a potential for decoupling. Because when you take a look at the longer end of the Treasury, yields have punched up beyond 5%. And on that day, overnight, our own T-bills ended mixed.
Yeah.
So some of the bond analysts out there are saying there must be a decoupling happening, that we're moving far away from whatever could happen to the U.S., which could be a recession.
Well, if you look at the credit spreads locally, it's mainly locally driven. There's a lot of supportive data that could really help us bring credit spreads lower. The inflation has gone down below target, 1.4% recently, and with the peso strengthening, we think that the BSP has a lot of room to cut rates. And if you look at the bearishness on the long end, this seems to be more so on the supply end. The BSP just issued the 10-year and 20-year, so we think that's why we saw some uptick in the yields.
Right, and it did pretty well, the 10-year.
Yes, definitely. So I think as the BSP cuts more, we think that we're more bullish on the credit space.
But how much more though? I mean, we've heard the Fed. They were supposing maybe 4 rate cuts, but now they're maybe seeing 2, and now I just read maybe just 1.
Yeah.
Could there be a decoupling as well? The Bangko Sentral having more room to decide on its own whether or not the Fed cuts a little bit more or a little less?
Yes. I think the decoupling over the past or in the current term is that we're really looking at the peso, and with the peso strengthening right now, we think that there is room to cut ahead of the U.S. Yeah.
Your peso exchange rate forecast then has got to be somewhere in the area of what? Because right now it's at 55 to the dollar.
Yeah. So for our DBS partner in Singapore, for our end peso 2025, we're around at those levels already, about 55.5 pesos. So we think that at current levels, this is already fair value.
What about for companies? As we've seen the first quarter earnings season roll in and seen inline expectations, yes, but maybe challenge for some industries like telco, power?
Yes, definitely. Well, as you mentioned, telco, there have been winners and losers. We saw Converge have strong results, which may be taking some market share. But so far, in terms of first quarter earnings results, a lot of these things were in line. We have seen some winners and we have seen some losers, but overall, in line with our expectations. And in terms of our stock picks, we have transitioned from earlier the year. We think that since there's a lot of risk in the market right now, we're looking at dividend players.
Such as?
Well, you have a lot. So our benchmark right now is the 2 years, since we have that 12 to 24 months of bear case for the U.S. or that U.S. recession case. So those stocks that have higher yield against the 2-year is you have A-REIT, M-REIT, RCR. You also have some consumers like Wilcon and RHI, which their yields have also gone up.
Right, consumer place then. I mean, this is the theme, overall theme. But when you look at the property market and you find that there is an oversupply in condos in the NCR.
Yeah.
How can you kind of avoid that when you want to invest in maybe a REIT?
Yeah, of course. I mean, REITs, if you look at the potential downturn in the US market and then in the Philippines following that, we think that REITs could offer some stable returns if we see some downtrend in the Philippine market. So again, if you are looking for that potential stable returns, you invest in A-REIT, M-REIT, RCR, which have competitive pricing against the US 10-year. I think RCR right now is about 6.3, 6.6%, which is pretty attractive already at current prices.
Consumer theme I get, but then when I look at the cumulative inflation over the past 3 years, it's still at record highs, even though we're already looking at inflation month on month at least 5-year lows.
Yeah.
So what's the justification for investing in more consumer counters?
Well, some of our consumer names like Pure Gold and Wilcon have good yields already. But what we want to see is, yes, inflation has gone up over the past few years. But what we want for that to happen is it to be more stable so that real income can catch up. When real income catches up, we can see consumer spending to improve. And then that's when you see that broad-based spending affect the markets and turn into better income for our consumer names.
Now, I'm seeing in your notes gaming. What's the attraction there?
Well, if
or
you
is
look,
it like a red flag?
Yeah, well, if you look at gaming, it's really two sides of the coin, right? You have land-based casinos and the online gaming. Well, one side has fared a little less than the other because there has been some problems in the VIP segment, with the China crackdown. That segment hasn't been that attractive so far. But if you look at the online gaming, really the most attractive space in the market right now. But we think that it could see some peaking in the near term. In the data so far in first quarter for the online space is it was flat quarter on quarter. But we think that it still has some legs. Election spending, lots of money going in the market. So it could potentially go into that direction on online gambling. So, yeah.
Now, there's a rebalancing coming, but not in the near future, but it's something that you're watching out for in August.
Yeah.
How come?
Well, we think that this rebalancing is quite unique. We released a report, it's called Changing of the Gaming Guard. So Bloom was included in 2023, but right now with the recent downturn of Bloom, and with Plus going up, we think that one of the criteria was market capitalization, and it seems like Bloom will be exiting the index, and Plus is entering. So it's really changing of the guards.
Pretty exciting
Yes,
then. So we'll watch out for that. Thank you so much, Kyle.
Thank you,
Appreciate
Kathy,
the
for having
views
me.
and insights. Kyle Garcia there of First Metro Securities.